Good morning and welcome to Business Daily right here on Trust TV. I am Yusuf Akogu. It's 3 days away from the inauguration of the new administration in Nigeria. And of course, the president-elect and the vice president-elect were conferred with the highest honor in the land yesterday, GCFR and of course GCON. And the president-elect did say that he is aware of the enormous task ahead of him as the president of Nigeria when inaugurated next week, Monday. Well, that is part of it. And he did say that he would not disappoint Nigerians. And that's, I think, is some of the positive that Nigerians will want to hear if you consider what has gone by in the last 8 years or thereabout. Welcome again to Business Daily. And now we give you the top stories at this time. Glad to have you back. Interesting development in the world of business. Quickly, we go down to the stock exchange to give you the data from the Thursday trading, and we start from the snapshot of the market on Tuesday. The market closed negative yesterday. That is after a very long time of positive trading. The all share index there down 0.02%, and of course the volume of trade that exchanged among investors yesterday 377.136 million volume of shares, value at 9.178 billion, and of course in terms of deals, over 5,000 deals, nearly 6,000 deals there, 5,879 deals there exchanged hands among investors. And if you look at it in terms of the gainers table yesterday, we saw the like of FTN Cocoa gaining 62 kobo there to close positive 8.77%, and of course Tantalizer also Wapik also on the gainers table gaining 26 kobo and of course 45 kobo respectively to close on the positive side 8.33%, and of course 7.14%. And on the losers table we have the likes of corn oil down yesterday, a huge loss the day yesterday, 43 naira the loss yesterday to close negative 9.92%, and of course Unilever Nigeria PLC also lost 14 naira 40 kobo, of course down there 8.28%, and of course the like of Entana Oil also on the losers chart there, losing 6 naira 80 kobo to close downward there at 6.21%. In terms of a top traded equities, we have the likes of United Bank for Africa, UBA, doing 86 0.2 million. And of course, Access Bank, they've been there for a very long time. Zenith Bank as well, the banking sector seems to be dominating the activity chart there. 67.4 and of course 39.4 million volume of shares of those companies exchanged. And in terms of performance across sector, we have a banking sector down 0.11%, and of course NGS Industrial also down 0.07%. There seems to be a lot of profit taking yesterday across various sectors. Consumer goods index also down 0.14%, and of course the oil and gas sector a little bit better there compared to the rest of the sector there, 0.23%, and of course the insurance sector also down 0.08%. Let's look at how the rest of Africa are actually doing. GSE in Ghana is our next door neighbor, also down 0.13%, deep in red. And of course, Nairobi Stock Exchange in the eastern part of Africa, the index is there way below 100 basis point there, down 0.84%. And of course, MSC in Malawi in the Central Africa gaining marginally 0.14%. These are the performance of the market across Africa on Tuesday. I have my guest in the studio. My guest is a professor of capital markets and finance from the Nasarawa State University, a former commissioner of finance in Imo State, Professor Uche Uwalike. Good morning, Professor, and thanks for joining us on the show.
Thanks so much, Yusuf.
Yes, quickly, I want to get your reaction. You're a professor of capital markets.
Yeah.
I want to get your reaction to the performance we see from the Nigerian market yesterday, especially.
Well, I would say it's in response to, well, partly to the MPC outcome we saw the previous day. The Monetary Policy Committee of the Central Bank further increased the MPR by another 50 basis points from 18 to 18.5%. So usually when you have that kind of move, the market responds because ultimately it's going to rub off negatively on the market, because the higher interest rates are, when you have high yields, particularly the fixed income, fund managers tend to switch from equities to the fixed income. I also noticed that the drop was mainly in high cap, stocks. We saw, drops in stocks like Geregu. Okay, Geregu is now about 299 naira. GT Corporation also fell, I think, from 27 to 26 naira. The same with Access. So a couple of high cap stocks, drops. And of course, over time, you've also noticed that a high cap stock like Airtel, that used to be 1,400 naira, now has dropped to 1,700 and something. So you now find that all of that, is contributing to the year-to-date return today is just around 3.06%. Which of course is very, very far below inflation rate of 22.22%. So what you are seeing is, you mentioned it, profit taking, more or less dominating. But of course we saw in the last 3 days before that drop, some sort of bargain hunting, was noticed.
I'm talking about bargain hunting now. Now that we are seeing this is the first day, first negative trading we've had for the week. Do you think this trend will continue till next week, or is it like investors are holding back to see what will happen? I mean, the government
yes.
we're about to have a new government.
Let me just pick it from you. You can say that again. I'm sure some positive sentiments will return to the market as soon as the inauguration takes place, and then the government takes off. I expect that the market will rebound to if I may use that word, on the back of the entrance of on the back of a birth of a new administration, as it were.
Well, interesting reaction there to the market performance. But again, we have a very good topic that we will be looking at today on the show. We will look at the performance of the government so far, and of course, the tax ahead of the incoming government. My guest is still right here in the studio. We'll get back to that discussion after this break. Don't go away. Glad to have you back. Of course, we are going into our discussion straight away. And of course, a whole lot of issues in the economy. Whoever, the next president of Nigeria shouldn't really be rejoicing, really. If you look at the numbers, the economic, the data that we are seeing in the economy, they are not really so impressive. So you show them some of those numbers here. We start with the GDP numbers. If you look at the GDP numbers from 2014, 2015, 2016, 17, 18, 19, down to 2021 here, it has remained on the decline. If you recall, in 2014, we had over $546.7 billion. That has declined down now to 436.29 billion naira. So this is the numbers that the incoming government will also have to contend with. Let's look at the CPI, the Consumer Price Index. Of course, the inflation numbers is one of the monsters that has threatened the life of our economy. Down up there, 22.22%, deep there in red. That's the last number released by NBS in the month of April there. So if you look at where it were in 2015, it was at 9.6%, but it has continued on the upward trajectory down to currently 22.22%. These are some of the indices that, of course, the incoming government will have to contend with. Quickly, we look at the next data there. Of course, the unemployment rate is another very, very serious issue there. In 2015, it was in 2015 it was there at 10.4%, but it has continued again, like it has always been, down to 33.3% in 2022, and of course, it's projected, according to KPMG, to rise to 40.6%. And of course, if you look at the youth unemployment, is way over 50%. And of course, if you look at the number of unemployment rate as released by NBS, 133 million Nigerians are in multi-dimensional poverty. These are not impressive data for whoever that will want to take charge of Nigeria in the coming days. Of course, we quickly look at the Nigeria debt profile, which is another big challenge. You look at it, in 2015, it was at 12.6 trillion, and of course, as at the present, is 74 trillion. That is, if you add the ways and means of over 22 trillion naira. So this is a very huge number that we have there. My guest, Professor Uche, is still right here with me in the studio. Prof, these are not impressive numbers.
Oh yes, there is no doubt that the new administration will have a huge task of fixing the economy. You showed the numbers there. The GDP numbers are even better presented when you look at them in terms of the growth rates. In 2015, for example, GDP growth rate was around 2.7%, and today the last GDP figure by the National Bureau of Statistics for the first quarter of 2023, puts it at 2.31%. All right. The point Absolutely. I'm making is that between 2015 and now, GDP growth rate has, on the average, not been above 3%. Okay. The highest we've had was in 2021, when GDP growth rate came in at 3.54%. And of course, you know that last year it came in at 3.51%. All right. But before then, in 2016, we had a recession. You recall? because oil price suddenly crashed. And in 2020, we also had another recession, no thanks to COVID. So while it's important to recognize that some of the factors that may have led to these recessions were not within the control of the government. The point must be made that GDP growth rate has been weak on the average from 2015 to now. And what that means, or what that has resulted to, has been this issue you mentioned, the multidimensional poverty. Because when your GDP growth rate, when economy is not expanding to the point where jobs are not being created, you have high unemployment rate, as you mentioned, 33.3%, and that is even as at the last quarter of 2020. All right. If we get this figure today, using the same methodology that NBS, has been using, the figure will be a lot, higher. So you have high unemployment, okay, side by side with high inflation rate. So the result is what? High poverty, high misery index. So poverty level has risen, not surprisingly, partly on account of the fact that GDP growth rate has been tepid, has been very weak. And once it is below population growth rate, all right, once it is not inclusive, that is the kind of results, that you have. Another macroeconomic indicator which you also mentioned is inflation. Okay, inflation has been on the rise, not because there has been too much money in circulation, as it were, okay, but more because of supply side factors, structural issues. Example is inadequate food output. That is why food inflation today is where the pressure is, above 24%, even though the average inflation figure is 22.22, but food inflation is 24. And in some places, all right, okay, food, like in Kogi State, for example, if you look at if you disaggregate the data, you find a place like Kogi State, food inflation rate is as high as 27%. So what that is saying is that we are having output issues. And part of what has caused that, is insecurity. Because of insecurity, rising, kidnapping and banditry, farmers are not able to go to farms. And so it's affecting outputs. So there are also issues to do with power. Electricity, which is a major enabler of any economy, a key dependency. So when you have high cost of electricity, inadequate electricity, the economy is, relying more on generators, okay, made worse, exacerbated by the fact that even the cost of fuel is high. So if you have high cost of fuel, high cost of electricity, you should expect, high inflation numbers. Rate. So numbers. So it's not just because there's too much money in circulation, as it were, too much demand. Too much money chasing too few goods. So what we have in our own case is more of cost push, more of supply side. And that is why it's been difficult for the central bank to tame inflation. So no matter how you can see what has happened in recent times, they've been increasing the MPR. Since May last year, central bank switched to a tightening stance, monetary policy stance. Okay? Today, MPR is as high as 18.5%. MPR is the rate at which the central bank lends money to commercial banks.
Absolutely.
And if you take into cognizance what they call asymmetric corridor, +1, okay, -7, +1 means they actually lend at 19.5. All right? So if commercial banks are getting to 19.5, by the time they ask their cost of doing business, you have rates as high as 25, 26, 27%, 28%.
Exactly.
So businesses cannot survive under that kind of
circumstance,
environment. So now that's why I've always argued that the approach to inflation in Nigeria shouldn't be actually to be using the traditional monetary policy tools. It is to look at these other root causes of inflation, which, in my view, fall within the domain of the fiscal, authorities. Now, you also mentioned the issue of, our fiscal space, fiscal imbalance. Of course, it's widening. Budget deficits are growing. And how have government been financing these growing deficits, which are more, unfortunately, on the recurrent side, all right? It has been through borrowing. So the pace of accumulation of public debt, has increased astronomically. I was looking at it again. You showed the numbers. In 2014 December, public debt stock was around 11 trillion.
Yes, approximately
today,
12 trillion.
Yes, today it is 46.2 trillion. That's the one before the ways and means are added. 46.2 trillion. If you work that out, that translates to over 300% increase 310% increase in public debt stock accumulation. All right, and of course, why it is a problem. The problem is in the debt service obligation, debt service to revenue. Debt service to revenue ratio is so high that by the time we finish servicing the debt, we are left with very little to pursue, development, issues. And that is what has led to some of these numbers you're seeing: high unemployment, high poverty, tepid GDP growth rate. Even in terms of balance of payments, look at our trade. It's still dominated by oil. Okay, we have not been able to diversify the export base, to the point where the non-oil sector, can contribute significantly with respect to forex. Oil sector is still accounting for more than 90% of our forex. So these are structural issues I think the next, administration, has to,
to deal with. Another issue again that you rightly mentioned, the budget deficit. If you look at the 2023 budget, it has over 11 trillion budget deficits that need to be financed through borrowing, domestic and of course foreign borrowings. And if you look at our current debt ratio to GDP is very, very high, though there have been a debate whether we have reached a threshold or not, but not forgetting the warning from IMF that we should reduce the pace of our borrowing. Now, looking at this kind of deficit that needs to be financed through borrowing, what do you think the incoming government, who is going to be saddled with this responsibility, what should be ringing in their mind right now? And what sort of advice do you have to offer? Yes,
the first is to recognize that we have a debt issue. Sometimes the argument is not a debt issue, it's a revenue issue. Grow your revenue, then that problem sorts itself.
So are you asking for more taxation, for more increase in tax, or bringing more people?
The argument is out there is grow revenue. I agree, you have to grow revenue. The problem is the rate at which revenue is growing, or you can grow revenue, okay, may not match the rate at which public debt is growing. So if you have revenue growing at say arithmetic progression, and the public debt is growing at a geometric progression, it can never catch up. So it's to recognize that there's a debt issue, and then to change strategy. All right, you have said it here. Debt service to revenue is the issue. Yes, debt to GDP ratio is under 30%, below international threshold of 56%, even below country-specific limit of 40%. Okay, but the problem is debt service to revenue ratio, which in my view is the true indicator of the debt burden. So it is very high. What do we need to do, therefore, is to explore in other ways, innovative means of financing infrastructure in partnership, with the private sector. Government cannot continue to borrow, particularly, okay, to finance recurrent spending. So the next administration should move away from borrowing to finance recurrent spending, because that is also what is fueling, inflation.
Oh, would that be possible immediately?
Nothing is impossible.
If you look at our current revenue ratio.
Yes, you see, and also if you look at the size of the recurrent spending. So what we now need to do is to look at that recurrent. Take, for example, 2023 budget. Recurrent spending is over 8 trillion, all right? Capital is about 6 trillion. And we have voted 6.3 trillion just to service debt. We've also voted over 3 trillion on fuel subsidy for 2023, and that fuel subsidy provision is just for January to June. If fuel subsidy is not phased out, or anyhow, it means that your subsidy is going to might hit 7 trillion by the end of the year. So part of what we need to do, as I said, is to look at recurrent, and part of the measures to look at recurrent is also address this issue of fuel subsidy. If we can phase it out, that means we are in a position to save as much as what we would have budgeted for for fuel subsidy, for me, the opportunity cost is very high. I mean, opportunity cost of maintaining fuel subsidy. So the new administration has to find a way of, dealing with that. But I must mention before time runs out, that in all this, it's important to also put on record that this administration has also put in place a number of things that the new one can,
build upon.
Exactly. And that's speaking to things like the Petroleum Industry Act, for example. All right. I also understand this current administration has signed a bill that will allow subnational governments to also go into power generation and distribution. And there's also they should also take credit for the some bright spots we see in infrastructure space, the roads, the rails, okay, Second Niger Bridge. Okay, these are things that they also deserve to be commended. And the new administration, as I said earlier on, should build on that and possibly also ensure that any project that is left uncompleted, should be completed. So on balance, yes, there are bright spots, as I said. They knew, but there are also challenges, and the new administration now has that responsibility, to ensure first continuity, all right. And speaking about continuity, the new administration should also, in my view, run with a plan. We already have a plan, a national development plan, okay, NDP 2021 to 2025. Which, of course, is part of the perspective plan of Agenda 2050. Yeah. The new administration must not jettison it and begin to, try to also have his own. So whatever he wants to do, let it be within that
framework.
That framework. So I think that would be my advice to the new.
That is interesting advice there, Professor Uche Uwaleke. I must thank you for your time on the program. Professor Uche Uwaleke is a professor of finance and capital market from Nasarawa State University, and of course the former commissioner for finance in Imo State. With that, is a wrap on Business Daily today. Join us tomorrow for more. I am Yusuf Akogu.